Good morning, everyone, and welcome back to the Schwab YouTube coaching channel for our Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from Denver, Colorado. Today, pleased to be joined by my friend and fellow coach, Brent Morris. Good morning, Brent. How are you today?
Doing good. Glad to be back on here, Kev, with you. I love Wednesdays and love to look at the markets. So I'm glad everybody's joined us as well.
As am I. See a lot of familiar avatars, familiar names in the chat there. We, of course, this morning are joined by our friend Cameron May there. He'll keep an eye on comments and questions that Brent and I are unable to get to, but we will surely do the same because we do enjoy hearing from you, bringing your questions into the discussion. So please feel free to post in there for the duration of the show. We will go about 45 minutes, of course. If you're not already doing so, remember, you can follow the three of us coaches, and really all of us coaches here on X. You can do that individually for us. Cameron May, CS, Brent Morris, CS, and Kevin Horner, CS. The X channel there, the best way to meet up with us when we're not hosting classes for you. What you'll often find from us are charts and data pieces, news, etc., that you might be looking for throughout the day and the week. So we would love and appreciate a follow there. Let's go ahead and jump to our disclosures so we can get into the fun stuff with all of you. So first, remember that our discussion here is always informational and educational only, meaning simply we do not make recommendations, nor do we endorse a specific approach to trading the market. What we will do is review technical analysis concepts, strategies traders may choose to employ, but all of the decisions in that regard are going to be based on your process, your plan. So please be certain to do your own due diligence in that way. As usual, we will follow our standard agenda. We're going to hit our biggest of indices. So we'll look at the S&P 500, the NASDAQ 100, the Russell 2000, probably the semiconductors and a few other industry groups perhaps, and sectors that are on the move. And then, of course, we've got some stocks in the news today for upgrades and downgrades. So we'll try to provide a clear picture of what's moving for y'all here this morning. Now, yesterday, Brent, as we kick things off, we'll always do that with the S&P, but I thought yesterday's candle kind of told maybe bulls that things were potentially setting up the way they were hoping for. What are you watching when you're looking at the SPX here?
Well, I'm watching. What kind of sticks out on your graph right there are our moving averages to me. That 50 and the 20-day moving averages, because we came right back down to them, and it appears, at least, we may be bouncing off those. And the pullback, probably not a surprise. We have pullbacks every once in a while, and well, more than every once in a while, quite frequently. But you don't want the pullback to extend too far. In this case, it seems like it went to about a level where a lot of traders would probably like to see it, especially off that 50-day moving average. And so, I don't know where it's going to go from here, but we do have the uptrend still intact. Of course, we will eventually have to deal with that 6,900 level again, which, I don't know how, I'm assuming we will at some point. But if we get up there, that's a potential resistance. But right now, I don't see anything super concerning in terms of the market. It looks like it was just a healthy sell-off at this point, to be honest.
Yeah, I tend to agree with you, Brent. I think the takeaway at the close for me yesterday was the fact that we basically had a perfect doji. In fact, the open was at 6,800.12 and the close was 6,800.26. You can't get a whole lot closer to a complete doji than that. And the signal of a doji on a one-day candle is simply indecision. And what I take from that yesterday, Brent, is the knowledge associated with the jobs reports. We got October jobs data. We got November jobs data. October data for the jobs were indicative of a weaker jobs report than we had hoped. But then November came over the top and gave us more jobs than expected. But nonetheless, it was a day where we were digesting. And to me, if we're digesting at an area of short run support, well, then perhaps what we've learned is the importance of that 50-day moving average at yesterday's lows.
Yes, and just to follow up a little bit on your comment on the indecision of the doji candle. So a doji candle is basically open and close being approximately the same level. You got that. That's the candle that Kevin's highlighting. The interpretation of it typically you have to look back at what it's been doing before that. If the market has been going down, which it had the 2 previous days, then what we're saying is, after this kind of downward momentum, well, people are kind of starting to hesitate. Maybe we're not going to go down so much at this point. So it's a potential reversal, a potential bullish reversal if it's preceded by down candles. Vice versa, if the candles preceding that doji are more strong candles, then you're going, well, people, maybe we're losing some of that upward momentum at that point. But, we'll see. Obviously, today's candle, we can't read too much into it at this point because the market just opened. But as you pointed out, I think the key is off that moving average is kind of a nice level to gives, I think, bulls a little bit more hope on that in terms of a bounce.
And you know what, Brent? Sometimes we get a little too fine in our analysis because we're watching the market every single day. We're paying close attention to these levels. But if you're looking for signals that can give traders reasons to start feeling a little more bullish or readying to deploy new money, for example, well, a doji at support after some selling, after digestion of important news that we've not seen for a while, all of that can play in. Now, the most important thing subsequent to that doji is where do we go next? And a lot of traders, Brent, are going to basically look at the range we created yesterday. If we can trade at a close today over yesterday's high, a lot of bulls are going to call that a hold move and potentially look to continue the shorter term uptrend. But a close under yesterday's low not only signals more weakness, but it takes out a very important moving average, Brent, and leaves us at risk to revisit the lows we saw in mid-November.
That would be a pretty bearish signal if we had that. And of course, there's a third possibility, and that is we have another kind of indecision day where we're just kind of kicking the can down the road, so to speak, another day, and then we'll just have to wait, and it just kind of delays that decision. But on this candle, ultimately, we may look at it as, it's a potential turnaround. But this, as with a lot of other, price patterns, for example, such as a channel or a triangle or something like that, it really just kind of depends which way we break out on it. And jury's still out on that.
Yep, way too early to know at this point, but we do like to talk about it, at least to have some ideas of what we're going to be watching for the remainder of the day. Now, the NASDAQ 100 did not get a doji yesterday, but it had a pretty appropriate candle for us. In fact, that candle might actually look a little more bullish for some traders, except that we still reside now for what I count as day 3 below our 50-day, making today for a lot of traders a very important day. Do we recapture the 50? Do we close above the 50-day, or do we stay underneath it, indicating potentially additional pressure here?
Yes, and the NASDAQ a lot of this is probably more sector representation. It's been a little weaker on the NASDAQ. Well, NASDAQ is more IT, more communications, and that has been a little bit of a weaker aspect of the overall market. And so we do see the break of the 50-day already on that NASDAQ. In fact, Kev, if we go to that SPX, $SPX A50R, and look at this is the percentage of companies that are above its 50-day moving average. Look at the change in that over the past couple weeks here. We're down close to 30% there about, I don't know, maybe a month ago. And now we're up over 50%. Why? Because we're seeing more strength among a broader aspect of the S&P 500 and not just those, kind of big tech type names carrying the market. So that's been kind of a change in the market, but I think that kind of helps to explain why the NASDAQ is now below the 50-day moving average and the S&P 500, even though there's, a lot of overlap and still a lot of big tech type companies at the top of the SPX, which are overweighted. But
Mhm.
I think that's part of the explanation as to the difference between those.
What a great call out, Brent. I appreciate you bringing that one to the table because you're absolutely right. Watching for a trend shift here can be really instructive. And also, it can be supportive of the idea that there is a broadening of the rally. But Brent, the broadening of the rally means potentially weakness in what has been our strongest group, technology, now maybe being supported by some of our laggers of late. Now, most recently, a couple of those big laggers were like financials and industrials that were in consolidation modes and have just broken to new highs. So that by no means is a negative, but it's also not necessarily the most constructive setup if we're looking for a continuation of the bull market that we've really seen over the last 2.5 years, really.
Yeah, that's true. I mean, the bull market has been driven by some of the, bigger sectors, bigger names, mega cap type stuff. And I'm not sure. I think a lot of analysts would say it's healthy to broaden out the
Mhm.
rally. That's a good thing for maybe the economy, but it's maybe not the best thing for just sheer quick market returns for
Yes.
traders. And so we kind of have a split there between those two elements.
That's true. And I think the part of that, Brent, is the reminder, though, that the market doesn't really move the way, consistently, it doesn't do what it's done the last 2 years. I mean, if we go back to the long term returns, on average, you're looking for about a 7% annualized return over a 40, 50, 60-year window. But we've had back to back in 23 and 24, back to back 25% SPX return years. Those are getting to be really, those are exuberant returns. We probably can't lean in expecting those levels of returns consistently. So, just a reminder of maybe how strong things have been and perhaps what we should be expecting going forward. We can temper our enthusiasm a little bit, maybe not looking for 25% returns, but still bullish returns nonetheless.
That's a good point. I mean, I think it's a healthy exercise to look at historical returns on the market, annual returns on the market. And you see up years, you see down years, no doubt. There's more up years than down years. You see big up years and small up years and big down years and small big. But after the market tends to correct itself after a while. And if you get many years of high returns, then people start to get valuation concerns on the market. And then you
Yep.
tend to get a lower year, or maybe not, certainly at least not as high a year. Now I don't know. Sometimes runs extend longer than you expect.
Yeah.
That goes on the kind of micro level of looking at an individual stock over a period of 20 days, when it goes up 18 to 20 days and you're going, wow, that's crazy. I can't believe that. The same thing can happen on the broad market for longer term. Sometimes you get surprised, but that's certainly the exception, not the norm. You typically don't see 25% returns 4 or 5 years in a row. You don't expect that, even though it is always a possibility.
Yeah, it's true. I think it's always a healthy exercise to try and bring us back to what may be considered normal, so that we at least, give ourselves expectations that are manageable. If we start expecting 25% SPX returns on a year-over-year basis every single year, we're going to leave ourselves probably with more risk than we have comfort for.
Hey, Kev, there's a question in the chat, and
Yeah.
I think it's a common one, and maybe we could just take a couple minutes or a minute to explore it.
Sure.
Fayez says, can you share those? You have some studies on the top of the chart here, and want to share them. And so maybe we could show people, hey, how do you add those to this top of your chart. Those are quick links, everybody. So if you just want, like Kevin has an ATR up there. If he wants to bring up an ATR, he can just click on that. That's a study right there, that little flask icon next to it. And then I guess those are study sets, I think, right? The 10-day moving average, 20-day moving average, and whatnot. And so it makes it easy for Kevin to just click between those. Now, maybe you don't care about what a 10-day moving average is or a 200-day moving average. That's fine. You can customize it to your own thing here. But if you want to add those, and you can choose what you want up there, you go to the little gear at the top of the page, and then on the general tab where it probably says off for you if you have never touched it, you go to on each chart, just like Kevin has. And then once you have on each chart selected, and you click on OK or whatever, and then in the upper right portion of the chart, you have the little gear, another little gear, and then you can choose to add buttons there that are either studies or study stats or styles or time frames. Play around with it, folks, with what you want, and you can add a lot on there if you like. So hopefully that helps there for you.
I'll tell you, Brent, I have used this tool in about all the variations available. Most, and at one point I had it set up so that I could access the box separately. So let me just save this here real quick. Let's revisit that, because I love doing a teaching moment as it relates to Thinkorswim. This thing is so expansive in what it offers. It can be really, really helpful. But
yes.
Get there with the gear. And the default is on each chart. But I'll mention that when it defaults, everybody, it is not pinned to the top. I have just unclicked my thumbtack there. And by doing so, that'll go away as soon as I pull it's supposed to go away. It's supposed to climb back up into the banner there. Yeah. But essentially, it's a hide and show function. By clicking on the push pin, it then stays there for me. Now, what I have are the most commonly used moving average details for me, along with my average true range that I will periodically add in as I'm building example trades and classes and whatnot. But I like that 20, 50, 200 day. That's for me standardized. That's my 3 big moving averages. But sometimes I need to clean it up a little bit, and I need to look at the only moving average I care about in a given window. Maybe that's the 50-day. So I just have one of these set up for just the 50 or just the 20 or the 200 exclusively, or my standard 20, 50, 200, but now I want the returns in there so I can quickly see what's the month to date, what's the year to date, what's the PE ratio on the stock I'm looking at. So you have a ton of access to this. As Brent pointed out, when we're in the gear here and you want to add, you can add almost anything you want. If you want it to be a draw set, if you want it to be a study set like I've created, or even a time frame, Brent, you can quickly utilize this tool to make any speedy fluctuation or alteration to your chart that you want.
You can. Just to give people a little example, you have some great examples there of what you have, and everybody can do their own thing. For example, I have implied volatility on mine. I have relative strength as a thing on mine. I have various different time frames, because often I want to switch quickly to a 3-year chart or a 3-month chart or whatever. I also have an RSI and a volume profile and pivot points and whatnot. There's a bunch of others, but just to give you an idea of some of the things you can look through. So it's just going to be personal to everybody, but once you know how to do it, because Kevin just showed you, play around with it, take a minute, and it'll save you some time in the future.
It sure can. Now, Brent, talk to me about what we're seeing in the Russell here. We did a 3-day pullback, as you can see, after making new highs. And that 3-day pullback came to possibly support. And we're bouncing a little bit, albeit today. We haven't traded above the high of yesterday just yet, but that's what we're trying to do. I called out the 20-day moving average crossing the 50 to the upside. At least we can start to see here that the trend might be reasserting itself.
Yeah, so we'll just have to wait and see. As you mentioned earlier when we were talking about the SPX, I think today, if we break below yesterday's low, and also, there's other potential levels of support you can draw. That's obviously a bearish sign. so far we have a green candle. We're up a little bit here on this. But we'll just have to wait and see where we close, because if we get a bounce there, that's looking a lot like a kind of a flag pattern, a bullish flag pattern, which is a bullish signal there from a technical standpoint. And of course, all these charts that we look at are going to be dependent on, news that comes out here. And so we'll wait and see. But right now, I would say today is a relatively bullish day, intraday. And in fact, if we switch over to maybe an intraday chart, a one day chart on that, Kevin, we can see what our action is for the day. You can see it climbing up there. And not all traders are going to want to use this shorter term time frame. It can probably be a little bit too much information. What do I mean by too much information, Kevin? What I mean is noise, right? So you can have too much information.
For sure.
It can give you false signals and whatnot. But for some traders who really want to look close and want to look intraday, this chart, you have a 5-day, 5-minute chart. So each one of these little candles here represents 5 minutes worth of time. But we have a clear uptrend. And when you're looking at these intraday charts, the same rules apply that you've learned over the years, perhaps, or maybe you're newer on technical analysis. Trends, higher highs, higher lows. You can still do those on an intraday chart. Support levels, resistance levels, indicators if you want, moving averages, they all apply to these shorter term charts as well. So I'm not advocating anybody here become a day trader or anything on this, but what I'm just saying is you can use the shorter term charts as well as the longer term charts to look at different time frames to try and help you with your technical analysis.
Yeah, that's the idea. At least for, many a trader whose time frame is that, 2 weeks to 6 week window swing trading per se. They're still looking at the intra-period charts to kind of offer shorter term signals, let them know what might very well be coming for the next move. What I find interesting here, Brent, was the break of the downtrend that's basically been that 3 days we've been talking about, followed by a continuation move. In fact, today's open was above the pivot, looking at yesterday's high, low, and close and giving us the average or the expected price of the day. That's that purple line. And the fact that we've held the 20-period exponential moving average as well, dating back to midday yesterday, looks like the development of a new short-term uptrend underway.
Yes. And Kevin, let me mention we have such a great community here, Kevin, because the comments in the chat are great. Kay Brown said, do not adjust the charts to the picture you want to see. Boy, what an insightful remark there, because there is always a temptation when you're looking at charts for a confirmation bias.
Yep.
Okay. I want to be bullish on this. I want to buy this stock. Therefore, what I'm going to do is I'm going to find the technical indicator that shows me something's bullish, or find the time frame that makes me think it's bullish, or find some signal, some candle, or whatever it is that makes me look at it, that gives me more of a confirmation of what I want it to do. Yep. So great point. Yeah, no, I mean, I think it's value. Now, that doesn't eliminate the reason why people will look at different time frames to get a whole picture, or possibly use some different technical indicators. But you need to check your psychology there and make sure you're not just leaning into your confirmation bias there.
Yeah, it's a really difficult process to undergo, understanding or recognizing when your brain is giving you this bias, right? You're trying to do, that's why we talk top-down method, right, Brent? I mean, it's what I kick off the show with our agenda each day, is the idea that we look at the biggest groups, followed by the sectors, followed by industry groups, to see where we have leadership. And if you take that top-down approach, constantly whittling from the biggest group to a slightly smaller, what you end up finding are the stocks that are the best performers in the leadership groups, and that can give you the confidence to take your trade. That's that same concept that we want to take to our individual approach in terms of setting up our equity trades. And I say what we want to do ultimately it's giving us the understanding of where the trend is and which groups are providing leadership. And so this is why traders trade the trends. Trends are more reliable than looking at a chart that's not trending, right? We can clearly see the Russell is upward trending over the longer term, right? At least back to April, we can see that much. Now, in the last week, we've had weakness. So short-term bearish pullback, but to an area of potential support. And so we take all of that longer range understanding as maybe the portion of the chart, Brent, that matters the most. And then if we take the view that we have a bullish uptrend that is longer run in play, therefore maybe more likely to continue, as we drill into the short-term period, hopefully what we're finding are signals that validate entry in the short run relative to the longer term trend. Does that make sense?
Yeah, I think that makes sense, Kevin. And I think it's important. That's why we use the same process each time. Since I've been with you, you've been using the 20-day and 50-day moving average. We've been looking at the trend. Here you have a year chart. And some people are going, well, how long is the chart should use? It doesn't matter. I think that personally, I like to use something a year or 6 months or 9 months to give you a good idea of the trend. I think it's helpful. I don't need to go beyond that to see the trend, but sometimes it can be helpful to look for past resistance or support levels to go to the longer term. But I guess the point is using the same process that we're using. It doesn't guarantee anything. I mean, look, this is kind of a relative strength approach. We're looking at a stock that's been strong as compared to other stocks there, or indexes that are strong compared to other indexes, and maybe kind of doing our fishing there, so to speak. But it doesn't guarantee we didn't happen to pick it at the very high point and it's just about to turn around by any means. But that's the approach, the methodology we're using here. And I think it makes total sense.
Well, I'll say, Brent, I sure do wish that every decision we made were infallible, that we know better than that. The market does plenty to confuse the majority 100% of the time. That much we also know. So we're not going to be right every time by any stretch, but by taking view over multiple windows, hopefully we're getting more insight and we can make a more informed decision. We then will fall back into trade management concepts as a means of helping us to expose dollars properly, which is to say the right amount of money at risk at any given moment. So it is a very wide combination of factors that are built into every part of the trading process, Brent. And I just think it's important to always continue talking about it. The more we talk about it, the more likely we are to maybe offer a nugget that a viewer or attendee hadn't thought of before. And it can be the one thing that just flips the switch for them mentally and gives them a better process somehow. So these are the things that we try to bring up, right? It's a class about analyzing the existing market, but also providing insights from a technical analysis standpoint as much as we possibly can. Brent, speaking about the relationships between our groups, we just got off of the Russell, which is moving out of that brief pullback. And I feel like the brief pullback has something to do with this potentially new established range that we're looking at in the 10-year yield. That's what we're watching here on the TNX CGI. What do you see in here?
Well, it's, rates are kind of stubbornly high. Can I say that? I mean, we'll have to see. You have a kind of an orangish line drawn there, kind of upper range, about 4.2%.
Bingo.
And that is where I think it would be a concern, I think, for a lot of people if we break out of that range here. In general, the small caps are probably going to do better if rates go down. This is the 10-year rate, but
Yeah.
there's different length of rates too that can affect it. But yeah, this is kind of, we had this kind of downtrend that was going for a while. Well, the downtrend isn't downtrending anymore. Now we're kind of in maybe sideways consolidation. Hopefully this isn't turning into a new uptrend. I guess we'll see here. We'll look for further, information from the Fed, number one, in terms of what they see and how the economy does, how inflation. I mean, there's a lot of things that affect interest rates. Economic performance affects interest rates. Inflation, perceived inflation, future inflation can certainly affect interest rates, because it all comes down to how much in demand, say, in this case, we're talking about the 10-year note is. More people, if there's more demand for the 10-year note, it drives up the price. It drives up the price of the note, and there's an inverse relationship between the yield and the price of the note here. And if there's less demand, if people go, look, I'm a little bit worried about, say, inflation, and therefore I don't want to lock in a fixed income instrument there because inflation is just going to erode it all the way, then they're being less likely to buy the 10-year, which will drive down the price, which will drive up the inflation rate there.
Yep.
The interest rate there. And so that's the relationships we're looking for. But this can certainly affect the market, not just mortgages, which we can all probably see that connection there, but in terms of like debt financing for companies is another thing, and just discount rates in terms of how you value future cash flows for companies as well.
A lot of stuff for consideration, right? Because we're not the only ones that buy U.S. Treasuries, of course, Brent.
Yes.
International countries, sovereign locations will buy U.S. debt and will also sell U.S. debt as they become less comfortable. So when things like a rough jobs report, for example, hit and large sovereign entities sell off U.S. debt, they don't do that in small quantities, Brent. They tend to do that in large quantity. And I think that's maybe why we saw what we've seen this week, which was a pretty big snap into that 4.2 level. But once more, oddly enough, that 4.2 line that I drew in has maintained. So we've not traded above it. And I think that that's allowed the Russell to maintain its upward bias thus far. We'll see if that continues.
Yes.
But obviously the reports we continue to receive, which are all lagging suddenly, will have a lot of impact on that.
Yeah, and just one last little thing, just to emphasize maybe your point. I think if we do break above that 4.2 significantly, you are going to start to see a drag on that Russell. would be my guess. But
yeah, I think that's the expectation that traders have, and hence the monitoring of the 10-year yield. It's kind of a big level, especially since we've noted just the date that we've been under 4.2 goes back to September. So basically the beginning of September. And if we go to September here, there's the base. I mean, look, we've been rallied. We came back. We tested the breakout from that level pretty much. And then we're back to new all-time highs just in the last 5 sessions. So to me, that illustrates the importance of maintaining under that 4.2 level, just like you said there. Makes a lot of sense. Let's peek in on our semis. They're flat today, but Brent, we are battling it out at an area that many traders would consider pretty important here in the short run.
Yes, and kind of going what we've said before today. We've had the pullback. Is this more of a flag, or is it that's going to bounce, or is this just a hesitation on a little stop on the way down? And we're kind of at our moving averages. We've got smaller candles right now. Here's our not a doji, but a little bit more of a hesitation. And if we break below into that maybe channel there, potential channel area, that would, those below the support level, that would be obviously not strong, but that also goes to the first thing we talked about, and that is some of those leaders, some of those sectors or industries that have led the markets have taken a little bit of a pullback here. And the stocks are some of those bigger companies, such as AMD and NVIDIA.
Yeah, a couple of names you may have heard of.
Yes.
We are going to be hearing from Micron in this space after the close today. So that one might bear watching. It'll have an impact perhaps on what's going on with semis. But 2 days at potential support, the 50-day and 20-day moving average confluence, along with former highs, now potential support. So resistance can become support. I'll go ahead and color that a green line just for our purposes there. So that's a very important level because, like you said, Brent, this has been an incredible snapback. By the way, the line if I drew it from here to here, it's 21% from trough to peak. So not too shabby over 2.5 weeks to bounce back 21%. So any pullback here never feels great, but nonetheless, you have to expect a little bit of a pullback after such a great pop. So we'll see if that can maintain. I thought it would be interesting to look at Micron, expecting Micron to report after the bell today. You can see that chart looks awfully similar to the semiconductor chart, doesn't it, Brent? With the new short-term high, RSI in a divergent pattern here. So maybe a little bit of a heads up, but hey, we've really been consolidating in Micron just as we have in the semis broadly.
Yes, we have. And so, we'll see when you have an earnings that can certainly change the narrative. It can change the picture because nobody knows exactly what's going to come up with earnings. And Micron is a big enough player that it can certainly affect some of the other semiconductors as well. If they have a good earnings, wouldn't surprise me if it pulled up some other semiconductor companies. But, it seems that in anticipation of the earnings, some traders have sold off just a little bit. Sold off Micron here, but you can see we got about a $22 expected range here between now and Friday, or about $20 market maker move for the earnings event, and the stock's at 236, so that would put the upper range about 255. The lower range about 215. Now, when I say range, it doesn't mean it can't go above that or below that. That's just like a standard deviation range, about 68% likelihood. From a probability standpoint, between 255 and 15 roughly. And just a different way of looking at the market, different way of approaching things. And there's, I think, some value. We talk about technical analysis a lot in this class, but it's not the only way of looking at the market. Probability analysis is a way. Fundamental analysis is a way too. But you can draw that on the chart or whatever.
I think so too, Brent. And the reminder that I'm offered, of course, is around these earnings windows. The high implied volatility commonly leads option traders to leaning in maybe to more selling of options, more so than buying options, because the implied volatility spikes in advance of that known event, and that makes option pricing increase, right? It gives a juice to the value of the contracts, so that tend to be a little more expensive in that way. So bear that in mind, but always good idea to look at least in advance of an earnings to get an expectation of what the IV means relative to the price. Again, like Brent said, the market maker expected move doesn't mean that it can't move more or won't move less. It just gives you the expectation tied to the mathematical calculations of implied volatility. Okay, Brent, I wanted to move off of semis and look at a story that hit today in oil, and it's tied to what's going on in Venezuela. The oil prices spiking after we hit a recent low. Look at the level we came back to, by the way, all the way back to $55 a barrel. Pretty darn low, but after Tuesday, President Trump ordered a blockade of all sanctioned oil tankers that are entering or leaving Venezuela, which of course escalates pressure on the government there. So the pop here is on the news, and yet oil has been in a pretty good downtrend for the better part of the last 5 months, Brent.
Yeah, that's an understatement. I mean, it's been oil is as low as it's been in years. I don't know how many years, several years. And um, let's see, yeah, about roughly
Yeah,
5
that's
years.
21.
Yeah.
Yeah.
So, and that was post COVID, I think, is
Yep.
one reason why it was because that kind of knock down demand and whatnot. But in any case, yeah, oil's been getting whacked, and this is just a little bounce. I mean, so yeah, we're up 1.5% today, but given the circumstance, not surprising. Given how low, I'm not sure that's even a meaningful change in terms of the oil price. The good news is for oil prices that they are so low is that really helps the inflation narrative, which is
Yep.
obviously a concern. And so from that standpoint, that's great.
Yeah, I'm not going to argue with that because we know that cheaper oil does good things for the inflation report broadly. So if we can continue to maintain these low levels, that's a positive for us. Now, today, amongst our sector action, energy is a leader, but it's also continuing this chart that's really difficult to discern, Brent, because my lines are indicative of a much longer term time frame, indicating that we've not really broken these levels for some time. I mean, I've got a bit of an uptrend line that I could alter and navigate and catch this recent bottom in here, but ultimately we've just been kind of squeezing into this new price range on this entire sector, haven't we?
Yeah, we sure have. And so this is energy, and it doesn't always, it's a very different chart than oil. And a lot of times people
Yeah.
think they're going to be the same. They're not. The energy is a much more uh, broad sector here than that. But we've got our pattern. It'll be interesting. Do we hold that 200-day moving average? Do we hold the the support trend? You can see that in the white line there, and we'll see what happens with that. Hey, Kevin, I want to kind of just I want to show you something because I was thinking about oil, and we were talking about oil, and one of the things we mentioned was inflation rates. It helps with inflation, but it can also help individual industries. Pull up like Southwest Airlines, LUV, here for a sec. And I don't know if this is 100% oil, but look at what that's done. Or American Airlines. The chart is similar. This somehow escaped my. Yeah, you can do that. Yeah, that's the easy way to do it, I guess, is just look at the whole group. Somehow I've missed that, and I suspect oil isn't everything to do with that, but I suspect it may be a pretty significant part of that there too.
Yeah, I missed that too, by the way. The bounce off the 200 here. This is a 28.5% rally, 20 bars, 4 weeks. But even if you were just a buyer on the break of the downtrend line, Brent, you would have been probably just fine from 21.95 to the peak. You're still up 16%. Brent, I always look for these opportunities to talk about scenarios, what we saw in the past and why traders take positions initially. The burst consists very commonly, the break of the downtrend line becomes the first entry for a lot of trend traders, and you'd have done just fine. The give back here has been limited at best. In fact, probably working against a 10-day moving average. Now, obviously, they're not going to all go that way, but this is the reason that traders look to buy into broken down trends, because they start to trend thereafter commonly.
Yep, absolutely. That's why we do technical analysis there, Kevin. Doesn't always work out, but it can be a methodology that a lot of traders find very helpful.
It's certainly fun when it does work out. It's in our favor, obviously. That's what we're striving for. Brent, I did want to call out a couple of upgrades today in the space of discretionary, as it turns out. So I wanted to quickly look at discretionary, which is kind of got an intriguing pattern here because we're moving to a level that's higher than the highest high we saw before the breakout. So this is a little notable in the discretionary space, but the two stocks that got upgrades here were Gap and Urban Outfitters. Gap was upgraded at Baird to outperform from neutral. They were also upgraded at Telsey Advisory to outperform from market perform. And Telsey also upgraded Urban Outfitters to outperform as well. So I'm going to put Urban up here. But Brent, the reason I thought it was interesting is that this would not be a group that I would expect to do well in the face of a market that was maybe under pressure. And so this might be reflective of a positive view that I wasn't expecting.
Yeah, I mean, this seems a little bit more on the discretionary end of things. And if you're concerned in the market, typically discretionary is not going to be at the top of the list of outperformers. But hey, it is these have been doing really well, and you get the upgrade. And it wouldn't surprise me if we pulled back a little bit, but because we have this kind of flag pattern thing going on right now. But hey, it's
we are at time, unfortunately, so we will have to wrap it there, everybody. But we really appreciate you joining us today. I did notice we had that survey in the chat, and if you'd like to offer the feedback, Brent and I have always appreciate hearing from you. So thank you for taking the 60 seconds to leave some comments there if you'd like. You can follow the three of us on X. We'd appreciate that. And if the discussion was helpful for you today, click that thumbs up down below. We're going to get this reviewed and archived quickly and into the list for attendees that couldn't make it, and they can catch it on the train ride home today, and that thumbs up will help us out quite a bit. So with that, thanks for being here, everybody. Have a great rest of your Wednesday. We look forward to catching up with you again real soon.